Hi, everyone. It's Peter Schiff. It is Tuesday, September 17th, 2013. Today, the Fed began a two-day meeting that concludes tomorrow. And later tomorrow, we will get the news from the Fed with respect to the highly anticipated tapering of its quantitative easing policy. I'm recording this today rather than tomorrow because I'm going to be on the road and might not have a chance to make a Schiff Report video blog on the topic, although I am putting out a commentary that should be up on the Euro-Pacific website tomorrow later afternoon that will address specifically what the Fed announced on Wednesday. But I wanted to talk a little bit about it today in anticipation of what the Fed might do. Now, if you recall from watching my blogs or listening to my radio show at schiffradio.com, from the beginning, when the Federal Reserve or Ben Bernanke first announced this tapering plan, I was of the opinion that it wouldn't take place according to schedule, that the Fed would not be tapering in September, which was its initial intention, because I don't believe it ever intended to taper. In fact, if you look at the rhetoric, tapering was always data dependent. It wasn't a done deal. Ben Bernanke didn't say, we are going to taper in September and we're going to taper by X amount. What he said was, it's our intention to taper so long as the economic data supports it. And the economic data was based on Ben Bernanke's belief that a real recovery had taken a hold, and he was basing that on his optimistic view mainly of the housing market, home prices, and the stock market, and the wealth effects related to higher asset prices and what it would mean for consumption and economic growth. Now, at the time, I knew that the recovery that Ben Bernanke was bragging about having helped create was phony, that it was merely a byproduct of the artificial stimulus, and eventually, as the stimulus was removed, the recovery would fade. In fact, eventually, even if the stimulus weren't removed, the recovery would fade, forcing the Fed to come back to the rescue with even larger doses of monetary stimulus. Now, over the months, the economic data has borne out my forecast. The numbers that we received have been, I believe, quite a bit weaker than what the Fed anticipated, or what the Fed was pretending that it anticipated when it first announced the taper. But, a lot of the investors on Wall Street and around the world are still clinging to this false sense of optimism with respect to the legitimate nature of the U.S. recovery and its ability to withstand a taper, or its ability to continue absent any Federal Reserve intervention at all. And in fact, now that we're a day away from the Fed's announcement, the consensus is overwhelming. I think it's 85% plus that the Fed will in fact taper this month. So I think Ben Bernanke may have backed himself into a corner with respect to his inability to really control those expectations, because Ben Bernanke was walking a fine line. He still wants to pretend that there's a legitimate recovery, but he really doesn't want to take away the only thing that's making it possible, which is the QE, and of course his 0% interest rates, which are not even on the table. I mean, the Fed is not even talking about raising interest rates. It's simply talking about reducing the monthly quantitative easing, the amount of mortgages and treasuries that it buys each month with money that it creates out of thin air. But I think Ben Bernanke may be worried about the psychological impact of a non-taper. If Ben Bernanke makes an excuse as to why the tapering can't start in September and leaves it open for a future date, that might spook the markets. It might cause the markets to have a more realistic outlook about the U.S. economy. They may be concerned that maybe the Fed knows something that they don't. And I think the Fed is very conscious about trying to manage expectations and not disappoint anybody, because the whole recovery is all based on false confidence, and the Fed wants to continue the illusion at all costs. So how would the Fed be able to do that? Well, maybe what Ben Bernanke will try to do is have his taper cake and eat it too. Maybe what he gives with his right hand, he'll try to take away with his left. Maybe he will bow to expectations and do a trivial taper, a taper light, if you will. Maybe simply pare it back by 10 billion, going from 85 billion a month to 75 billion a month, which is still a lot of money to print. Even had the Fed never done 85 billion, had it simply been doing 75 billion all along, that's still an unprecedented amount of massive inflation, of government inflation. But let's say the Fed does do that, but then assures the markets that it's going to go slow, that it's still data dependent, that it's not necessarily going to do any additional tapering unless supported by stronger economic data. In fact, maybe Ben Bernanke will try to do more than that. Maybe he will go back and revise his goalposts with respect to unemployment and inflation. After all, the unemployment rate has come down, but not because the unemployed have found jobs, but because they've quit looking and exited the labor force. Maybe Ben Bernanke will acknowledge that and maybe say, well, maybe 6% is our threshold for the unemployment rate, or maybe we need to see labor force participation pick up or real job creation. He might also talk about the supposed lack of inflation. We got the August CPI today. What do you know? Just up 0.1%. Now, I don't believe those numbers, but Ben Bernanke could use those numbers as another excuse, saying, well, we still don't have to raise rates because of where inflation is. And maybe he'll use it as an excuse to slow down the taper, because Ben Bernanke is very worried about how the market might react to A, his tapering, and B, if the markets try to think forward, that this is really the beginning of a longer process that will ultimately see the end of QE sometime in 2014. The bond market could look forward to that, and interest rates could rise even faster. The Fed is already upset that rates have risen as much as they have, which is showing that it's really losing control of the long end of the bond market. It's trying to talk interest rates back down, but it's hard to do that while it's also talking about tapering. So the Fed has got to figure out a way to say it's going to buy fewer bonds, but also try to prevent bond prices from falling, because in the absence of Fed buying, how is the Fed going to contain the damage when everybody else wants to sell to get out in front of the Fed? You want to front run the Fed's trade. You don't want to get crushed. So it's a difficult maneuver that the Fed is going to try to pull off. But you've got to remember where all this conversation started, because we're only talking about tapering the amount of QE. This is not, even stepping on the brake, right? Ben Bernanke uses this analogy himself. He says that we're just easing up on the accelerator. We're still stepping on the gas. We're still moving forward, just at a slower rate. When Ben Bernanke first launched QE1, of course, it wasn't called QE1 at the time, and the anticipation was that there wouldn't be another QE. It wasn't until that we had QE2 that we came back and put a 1 after the original QE. But if you remember, Ben Bernanke back then always talked about the exit strategy. This is only temporary. The Fed is going to unwind this balance sheet. We're going to sell the bonds that we're buying. Now, if you remember, back then, I said that was BS, that he had no exit strategy, that the Fed had checked into a monetary roach motel. Well, now, again, we're not talking about exit. Tapering isn't exiting. Tapering is still expanding. We're still entering. We're still going deeper in to this monetary experiment. A end is nowhere in sight, because in order to shrink your balance sheet, not only does it have to taper back to zero, not only does the Fed have to stop buying any mortgages or treasuries, but it has to start selling the mortgages and treasuries it already owns. Sell to who? And what's going to happen to a phony economy that's totally propped up on cheap money, low interest rates, when those low interest rates move up? But also, again, as you recall, that very first 60-minute interview with Ben Bernanke, when he was also talking about the exit strategy, he was also very careful to defray criticism that 60 Minutes brought up that he was monetizing the debt. And Ben Bernanke said, no, 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 we're not monetizing the debt, even though that's exactly what he was doing. He was turning debt into money. But Ben Bernanke said, I'm not monetizing the debt because it's temporary. Yes, we're buying treasuries, but we're going to sell those treasuries back to the market. We're going to shrink our balance sheet. This is just a crutch, a stopgap measure, right? So it's not debt monetization. Today, that's not the conversation. Ben Bernanke admits strongly that he has no intention of selling any of the treasuries, that he's simply going to allow them to mature, which means based on his own nonsense criteria, he would have to admit today that he's monetized the debt. I say he's going to go one step further. He can't let the treasuries mature, because if the treasuries mature, the government has no money to pay off the Fed. That not only does he have to hold his portfolio to maturity, but when the treasuries mature, he has to reinvest the maturing principal. Otherwise, the government can't pay. The government would have to sell those treasuries back into the market, and without the Fed, there are no buyers. So we move from an exit strategy to permanent QE. All we're doing is talking about a reduction in the rate of increase in the balance sheet. Meanwhile, the Fed's current balance sheet will never shrink, because all of the bonds that mature will be rolled over, as will all of the interest that the Fed earns on those bonds. That too will be reinvested and isn't even part of the taper. Now, here's the key. I think regardless of whether or not the Fed bows to expectations and tapers, or delays the taper for fear of an adverse market reaction, but the market could react adversely regardless of what the Fed does. In fact, if you look at the bond market, you look at the chart on the 10-year or the 30-year Treasury, it's a pretty powerful move down right now in bond prices and up in rates. Regardless of what the Fed does, interest rates could continue to rise, confounding the Fed's, attempt to keep rates down. Once this genie is out of the bottle, it's going to be very hard for the Fed to contain it. And I believe either way, the economic data that has already been weaker than what the Fed had anticipated when it announced the tapering plan, the data will continue to get weaker, because the U.S. economy never recovered. It's sicker than it's ever been. It simply looked like it was recovering as we were spending all that borrowed money. It looked like we were creating wealth, but all we did is inflate asset prices. Meanwhile, we don't get real economic statistics from the government. We get a bunch of propaganda. So a number of people are fooled into thinking a bubble is real. The same people who were fooled from 2002 to 2008. We just commemorated, I don't know if that's the right word, but we looked back at the 5-year anniversary of the Lehman bankruptcy. And the conventional wisdom is that, we solved our problems, we learned from our mistakes. Everybody is trying to rewrite history. I put a video blog on my YouTube channel. If you haven't seen it, you can go check it out. But I juxtaposed Barney Frank's statements on CNBC yesterday to what he said on the House floor. Barney Frank is reinventing himself as the hero of the housing bubble. To hear Barney Frank talk, you'd think he was Peter Schiff back in 2004, warning about the housing bubble, warning about Freddie and Fannie. He claimed that way back in 2004, he was skeptical about housing. He was trying to introduce regulation to rein in Fannie and Freddie, that he was an advocate of renting over buying. Yet I played part of what he was saying on the House floor in 2005, where he was doing the exact opposite. He was trying to, put out a small fire that was burning in Congress by some concerned legislators that were worried about the housing bubble, that were concerned about the risks in the credit markets. And there was Barney Frank telling them there was nothing to worry about, that housing was sound, that it wasn't a bubble, that prices wouldn't fall, that there was no reason to try to stop what was going on. And he basically stated that housing is solid, and that's why I will always push for home ownership. So in other words, he was a liar, but everybody is lying when they're thinking back at that crisis. But the point is that the people who confused a bubble for legitimate economic growth are making the same mistake now. They still think the U.S. economy is recovering when it's not, because they still don't understand the nature of the disease that we suffer from. That's why they were surprised by the financial crisis in 2008. That's why they've been fooled once again into believing that what we're experiencing now is a legitimate recovery when it's more of the same. We haven't solved any of the problems that led to the 2008 financial crisis. We've made them all bigger, which is why the next financial crisis is going to be worse. And maybe we'll see more of the beginning of that after we get a reaction to the Fed's taper or lack thereof. But I believe, again, that the economy will continue to deteriorate and interest rates will keep rising. And higher interest rates will only add to the problems of the economy, because as interest rates rise, that number one deprives individuals of spending because they have to spend money paying interest. They don't have it for other things. Corporations now that levered up to buy back stock, they have to spend more money paying interest on what they've borrowed. The U.S. government, with over $7 trillion in debt, getting ready to raise that debt ceiling again, it's got to pay higher interest on its maturing short-term bonds. Plus, I think the dollar will continue to weaken. It didn't gain much strength at all based on the threat of war in Syria, which should be very problematic, that traditional safe haven status, which is not really deserved, yet the dollar had it by default. It didn't really show any sign of strength this time around. I think the currency is getting ready to roll over. We'll see what happens tomorrow. But a falling dollar and falling bond prices, so not only do we get higher interest rates, but we get higher consumer prices. In fact, gasoline prices continue to rise, food prices, other costs continue to go up, despite the fact that the government pretends that prices aren't rising. Consumers have to pay the higher prices that the government is pretending doesn't exist. But that means if you're spending more for gas, if you're spending more for food, you don't have as much money for other things. And so the economy will continue to drift into recession. And so I think regardless of the amount by which the Fed tapers, the taper is simply a down payment on more QE. We're at $85 billion a month right now. Whether they taper to $675 billion or something smaller, the Fed is going to have to do an about face on the taper. And I think the Fed is going to be forced, now this is not the right thing, but this is what they're going to do out of desperation. They're going to untaper, and they're going to bring QE back above the $85 billion a month that they originally tapered from. That means eventually the Fed will be doing $95 billion, $100 billion or more. Because again, the QE is just like a drug. And just like any drug, the more you do, you build up a tolerance. And so you need more and more of the drug to get high. The problem with the U.S. economy is, even though we're taking more and more QE, we still can't get as high. You get diminishing short-term returns from more and more QE. And again, like all drugs, they're ultimately lethal if you take too much. I do believe that that's where we're headed, is for an overdose of QE. And it's not going to be the Fed. The Fed is not going to voluntarily withdraw. It's not going to taper this thing down to zero. No. I think eventually the Fed is going to be forced to do it. And it's not just going to be easing up on the gas pedal like Bernanke says. They're going to be slamming on the brakes. And then they're going to have to sell a lot of these bonds that they've been holding on to. But it's not going to be the Fed that decides. And it doesn't really matter who succeeds Ben Bernanke. I mean, now it's not going to be Larry Summers. Maybe it's going to be Janet Yellen. It doesn't really matter, because they're going to pursue the same failed policies until the end. Because when the market finally brings an end to it, when we have a crisis, when we have a sovereign debt crisis, when we have a dollar crisis, and then the Fed has no choice, that's when they taper, when they can't do it anymore. And again, it's not a slow process. We're going to come to an abrupt stop. And when that happens, the financial crisis of 2008 is going to look like that proverbial Sunday school picnic, because it's going to be a lot worse and there's going to be no bailouts. But the good news is we might finally actually deal with the problem. Instead of making the problem worse, we may have no choice but to solve the problem, because the government will do the wrong thing until it can't do the wrong thing anymore, until it no longer has the opportunity. And fortunately, eventually, the markets, in the currency market, the bond market, will force the Fed and Congress to do the right thing. In the meantime, my investment strategy is the same. I'm continuing to get out of dollars, buying the weakness in the precious metals market. We'll see what kind of reaction we have in the gold market and the silver market to the news we get tomorrow. In addition, I'm continuing to favor developed markets and emerging markets outside the United States. Again, don't forget, go to the Europac website to read the commentary that I put out yesterday. I might be able to finish it up from the plane. But I'm going to have a specific reaction because I'll know the numbers by then. I'll know exactly what the Fed did. It won't just be me speculating as to what they might do. Again, bye for now, and don't forget to continue to listen for daily updates to what's happening in the markets and the economy with the Fed on my radio show, Schiff Radio. You can listen at schiffradio.com Monday through Friday, live, 10 a.m. to noon. Again, it's called The Peter Schiff Show, and it's available at schiffradio.com. Bye for now.